All right, just make sure it's recording. And I think we are. So, welcome, guys. And thanks for joining me. I'm Tom Crown. And big shout out to Prime XBT for this webinar series they're putting on. I love anybody who embraces crypto culture, kind of for the benefit of everybody. So, very much love it. Doesn't matter what they're doing. It's just awesome that they're putting it out there. So Prime XBT is giving away $250 to somebody after this stream. Not sure their criteria, I think, is like people being active. So be active. Comment, whatever. Sorry. So if you haven't signed up for Prime XBT, you can see my link below. If you're on YouTube, I have my link there. It's the first one in the links that I use description. So today, my webinar topic, I want to talk about something that I observe every day from traders that frequent our stream, from new traders, from people entering crypto, pretty much just anyone trying to get into the trading business. I see this all the time, and in my opinion, it's probably the greatest cause of loss from them. We've all heard of FOMO, but I think what we're not aware of is that FOMO really goes in both directions. There's FOMO up and there's FOMO down, and really what this comes down to is emotions. So why do we do this? I'm gonna turn my phone off. Why do we do this? And especially, why do we do this when we see... I remember doing this when I started trading. When we see we're making loss after loss after loss, and I certainly had a lot of losses when I started crypto. And I started trading left and right. So why do we keep doing this? And that is the topic of my webinar. Essentially, trading mentality and emotional management. Our bodies, our minds, we are machines. We need to devote time every day if we want to be like at least a full-time trader, but really, even if you're not, trust me, I've stayed up all night, many nights in a row, watching candles, and it feels like that's the right thing to do, and it just isn't. We're like a car. We're like any machine. We're like any computer. We need the proper maintenance. We need the proper care that keeps that machine working. It's like a car is a good example. Like I was saying, you can't expect a car to keep performing without changing the oil, without changing the tires, without regular maintenance. And that's the first step, in my opinion, to getting into trade mentality that is successful. When you can get to that point where you are taking care of yourself, meaning getting enough sleep, taking time off, eating healthy, socializing with people, having a life outside of trading, outside of candles, you need a balance. Everyone needs a balance. I spent way too much time personally not balancing that, and it's never led me to success. So that's part of what I want to share with you guys today, is that once you can acknowledge that and internalize that you need to take care of yourself, you can move on to the next steps of where are our shortcomings in trading. So basically, when you neglect taking care of yourself, you are putting yourself in a position to be very stressed, to be very reactive, honestly just to make poor decisions, to make bad decisions based on being tired, based on being stressed out by everything else. So that is, before I get into anything, that is the first thing I want to say, is I see it all the time here. People don't sleep, they don't do whatever. You got to take care of yourself. And when you are taken care of, then you can start breaking it down. And so, in my opinion, the next step to breaking down trading, and this is really something for people who are new to trading mostly, but I think it applies to all levels of experience, is becoming aware of emotions and understanding how these emotions influence your actions and how they influence your decision-making process. And I think once you can at least have these in mind, I think it takes a lifetime to master this, honestly. But once you can have these in mind and start being aware of their influence on you, you can get into what I call as the trader's mindset. The trader's mindset is patient. The trader's mindset is calm. It is unreactive. It is calculated. And I think most importantly, it's confident. It's understanding what you're getting into when you make a trade and what that means up or down, with your trade or against your trade, knowing what that is and knowing what potential you have there. Side note, I don't at this point ever enter a trade unless I feel patient, calm, not reactive, calculated, and confident. If I don't feel all those things at the same time, I'm not going to enter a trade. I know that I'm not mentally prepared for it and that I'm probably going to make a bad decision despite having focused on these things for a long time. Everyone is susceptible to them. We are humans, and humans are very much run by emotions. So let's get back on track. Once we get this healthy balance in our own lives, we can then go into what are the motivating factors in a market? What are the motivating emotions? And those emotions, in my opinion, are fear and greed. And every other emotion can fall into a spectrum there, but those are the main motivating factors. You're either afraid of losing or you are overly consuming of winning or profit or greed. And I think most people will probably roll their eyes and say, oh, I know all about this or whatever, but I think it's really something that people overlook. They all kind of say, oh, I get it, check, I'm not that person, but everyone's that person. It doesn't matter if you are brand new to trading or have been trading for years. There is some level of fear and greed playing in every trade you make. And really what I'm going to talk about here is that a successful trader is one who can reduce the impact that fear and greed have on them. So fear is a natural response. We all have it to any perceived threat. It's basically hard-coded into our DNA. It's to protect us from danger. It's something that we all experience. It doesn't have to be trading. It can be anything. You can be driving in a car and feel fear. Certainly, people feel fear commonly in trades. And it is something that we've grown to have to protect us from danger, like I said. But it also can lead us to failure. Fear can prevent us from taking wins. Fear can encourage us to enter losses. This emotion is so prevalent in trading. It is so obvious in our stream here that I think is super important. And it's something that we need to acknowledge even if we think we understand what that means. So on the other side of the coin, there's greed. Greed, in my opinion, is the much, much harder part to deal with, which might be kind of counterintuitive to you guys. But greed is a good feeling, whereas fear is a negative feeling. And it's so much easier to allow a good feeling to kind of take over than it is a negative feeling. I think we all fight that naturally. But when we feel good, we really want to double down on it, triple down on it. We want to own it. We want to keep it. So I think that's where greed is honestly the harder side of this coin. And I think it's where new traders get really tripped up the most. It's driven by a desire to win. It's driven by ego. It's driven by desire to do better, to climb. But it really, when unchecked, can lead us to situations that are extremely risky and don't have an upside in comparison to the reward that they offer. So both of these emotions are completely natural. You should not feel bad, or you shouldn't feel any negativity acknowledging that these exist within you, because they exist within all of us. And to some degree, they are unavoidable. There's no one in the world who can throw a bunch of money down on the table and feel nothing. Like you're gonna have an emotional reaction to everything you do, and you probably aren't aware that you're even doing it at the time. But I believe that by actively identifying these sources of fear and greed and incorporating them into what we do on a daily basis in our trading, I think we can improve as traders. So I don't have infinite time today. So I'm going to identify what I feel is the three, probably the most common and the strongest factors in emotions when it comes to trading specifically. So one, when we're faced with a decision in the moment, our bodies naturally hit that flight or fight reflex, and we pump adrenaline, and we feel like we have to make an action right now. And what that leads to is FOMOing in and FOMOing out, whether that's buying on a pump or selling on a dump. It's an impulsive decision, and it is purely based in emotion. It's not based in logic. You can argue that it's going up, so logically I want to buy it, so it goes up. But it's not. You're in the moment, and your emotions are taking control of your logic, and your logic is thrown out the window. Number two is position size is so important to trading, and most importantly, it is relevant to emotions. When your position size is larger on any given trade, your emotions are probably going to be equal. If your position size is 100% of your portfolio, you are going to have such an emotional response if it goes down. Even 0.5%, 1%, you're going to freak out, because all of a sudden you're in this, again, flight and fight reflex where I don't want to lose, and I see I'm losing. Number three, and this is the most common one in my opinion for new traders. Experienced traders, this is probably just review, like everyday business for you, but new traders feel like every trade they do has to be all in, all out, 100% of their portfolio. They think that somehow one trade is all they need, and that's just not how it works. And I think that is honestly the largest compelling factor to being emotionally driven in trades. And it's a surefire way to be in the grip of emotions. If you're 100% in on a trade, honestly, I don't think there's any way anybody can not be emotional about it. Because it's everything. It's your whole portfolio. It's all you have invested, all you've worked for, and it could disappear in a snap. I would find it so hard for anyone to tell me that they can throw their whole portfolio on something long or short and not have an emotional response. I feel like they'd just be lying. So how can we manage this? And that is the point of this webinar. Is I hope to give you guys some tips, some insight on how to manage this and how to be successful. So the first step is to create a plan. Doesn't really matter what your plan is. It doesn't have to be the best plan. The most important part is to stick to that plan. And preferably, whatever plan you come up with is a plan you've created in the past. You have this ready. It manages your position size, and it clearly sets out your profits and your losses that are potential on this trade. Every single trade you make, especially with margin, every single trade you make should have a plan before it's executed. It sounds simple, and on paper it's super simple. But in reality, it's not as easy to stick to that plan, which I'm sure we've all experienced. I've experienced that, where last second I decide to change it. I'm not sure that's ever gone well for me, but I've done it. I'll tell you a secret. Pro traders never do this. Professional traders, and I don't even consider myself like a professional trader, but the people who I look up to, they do not go all in long or all in short on anything. They are managing their positions because they understand what trading is at its core. You cannot win every trade. There's no such thing as someone who wins 100% of trades. Um, there's no trade that is 100% guaranteed. There is always a chance of it going the wrong way. You will not get rich off of one trade. I hear a lot of people being like, I'm gonna go 100x right here, and then I'm never going to ever trade again, and I'm gonna retire. Awesome. That doesn't happen. Name me one trader who has ever retired off of one trade. I welcome it. I just don't think it exists. I've never heard of it. It's kind of just a fairy tale. And I think it's a fairy tale we've all told ourselves and thought and believed. I thought maybe this is the time that this huge trade works out and I'm retired now or something. It's not how it works. Trading is 100% a marathon. It doesn't matter if you've won 10 out of 10 trades. It doesn't matter if you've won 20 out of 20 trades. You can keep scaling it. It does not matter unless you plan on quitting right there. You're ahead and you quit. I've never heard of that either. That's equally a legend or a myth as trading one trade and retiring off of it. I've never met anyone who stops trading once they're up and once they're on a roll and hot and continuously on a hot streak winning. I've just never heard of it. I'm sure it exists at some point, but it's not really in our humanness. We don't like to quit when we're ahead. We like to keep going. We keep rolling the dice. So whatever plan you guys come up with for yourself should reflect that. You can't look at trades in a bubble. You can't look at, I won one trade, I won 2 trades, I won 10, I won whatever, and say, so this is who I am and this is what's always going to happen. Trades can't be looked at in a small sample size. Trading is a marathon. Trading is trade after trade after trade after trade after trade. Hundreds, thousands of trades averaged out. And that's what makes you a trader. It's not, I made one trade and I won. It doesn't make you a trader. That made you someone who guessed right or had the right information. Doesn't really matter. One trade or any kind of small sample size bubbled is just not indicative of any future results. It's about thousands of trades. It's about continuing to trade. Can you, out of those trades averaged out, continue to succeed? And I think that's something that people miss a lot. So I definitely want to talk about that. When you'll all experience this when you keep doing this, and as you see this marathon keeps going, you'll see there are winning streaks. There will also be losing streaks. I think this is where a lot of people fall into the trap, is most new traders refuse to acknowledge that, especially with a small sample size. They think, I've won these, I'm going to always win these. That's not how statistics work. You might win 100 in a row, but then you might lose 100 in a row. And I think this is where they get trapped, is they don't build into their plan the losing streak, the lost trades. If you're ever going all in on one trade where you're setting yourself up to potentially, and this isn't the worst case scenario, but potentially you're saying, I'm going to go up, it's going to go up or down, and if it doesn't and it goes enough against me, I'm going to lose my whole portfolio. I used to do this and I got burned hard when I started trading. Straight up, I lost a ton of money. I learned my lessons. I learned by fire. I think we all learned by fire. Hopefully someone can hear this and learn from the lesson I learned. But when you open yourself up to 100% loss for a total loss, you don't get another chance. Your portfolio's gone. You have nothing to trade with. Your plan, whatever that is, needs to be built in that you can lose over and over and over again and not be out. That is the biggest part of trading is you need to hedge against ever being out, like ever being zeroed, ever being done. When you're done or zeroed, you have no chance to get back in. You can maybe find more money to put back in, but with the way you traded the money you had before, you're probably going to end up the same way. Personally, through that trial of fire, my trades now, I limit them to maximum 2% of my portfolio total. That is a big trade for me. I don't usually employ that number, but that is the highest I'm going to go because I've seen the win streaks, I've seen the losing streaks. Hopefully averaged out, you win more than you lose, but at 2%, you can lose 49 times in a row, and you're still in. You still have 2% left. I know that sounds terrible. That's not what you want. And realistically, 49 losses in a row is very, very... that's statistically crazy, but it could happen. If you are going to have yourself out in 2 trades, 1 trade, 3 trades, 5 trades, you're just literally rolling the dice. You're rolling the dice, and you have good odds of winning, but it only takes one time for that dice roll to come and you're done. So that is a huge part of position management, I think is the point I was saying. I don't know. Got a little sidetracked. Basically, yeah. So I can lose a bunch of times in a row. That's built into my plan. Your plan has to account for every scenario. It can't just account for whatever you've seen continuing. This is not how trading works. Statistics don't favor a small sample size continuing forever, honestly, ever. So yeah, I've gone through these loss streaks, and what my plan has done is it has allowed me to continue trading because I know that if I lose a lot in a row, it's just a matter of time till I probably have a winning streak, or at least my luck changes. Even if I'm the worst trader in the world, if you lose 10 trades in a row, every single loss after that, statistically, you're probably going to have a win. The win is going to increase just by chance, not even by skill. See, it's so important to, first and foremost, protect yourself from being completely leveled. Number one thing to avoid, I have this written here specifically, in trading is the potential for total loss. If you roll the dice enough times, eventually you will lose, guaranteed. Even if that percent chance is 0.1% chance, eventually you're going to roll that 0.1 and you're going to be out and done and all of your gains are gone. You've lost everything. And so in order to successfully trade, in my opinion, you can never allow that scenario to happen with any percent chance. You're never betting at all. You're never selling at all. You're never buying at all. You're moving what a lot of people would consider slowly. And I think that doesn't feel good to most people, and I understand. Out of anybody, I understand. But let me tell you, slowly winning over time feels way better than losing 50% of your portfolio in one trade. And pretty much that's what happened to me in my first few weeks of trading, because like anybody, I saw some wins and I thought this is going to last forever. I won a trade or two, like I'm just going to keep winning. No, that's just not how the universe works. And I think we all can honestly realistically accept that, but I think our egos have a hard time accepting that. So yeah. Before every trade we should calculate our risk and reward. We should have a take profit set. We should have a stop loss set. And so ahead of time, we know what we're willing to lose and what our target is for gaining on every trade. Then you do not touch it. You have had the foresight of setting this trade up, of picking out a target, picking out a stop loss, and you're setting this and you're saying, I'm willing to lose, just for whatever example, I'm willing to lose $1 and I have the potential to gain $3 or something. That's a 3-to-1 risk reward. You should calculate this out on every trade you make before you make it. And then you don't touch it. So you made this plan, And when you have that inevitable urge to change it midway because you think, oh, there's a candle that went against my trade, I should change this. That is emotions. That is a perfect example of your emotions interfering with your plan. And certainly there's been times where emotions have saved us on trades, but I think almost every trader would be better off had they not done that. You set a limit order, or whatever order. You set a stop loss, you set a take profit, and you leave it. By doing this, you're no longer making decisions in that moment that are fueled by emotions. You're no longer pumping adrenaline, having a fight or flight response. You're never taking a risk that you're not prepared for. You're never taking a total portfolio risk loss. And you're never trading more than you want to. You've like measured it out beforehand, and you're saying, I can lose this and gain this. And over 1,000 trades, or however many trades, you're going to find that the average works out in your favor. If you take any given sample of those, it might not work out in your favor. It's just not how statistics work. Everyone trades differently. Everyone will have a different plan. Whatever plan suits you best. I think that the important thing to take away here is that plans need to be premeditated. They need to control how much you're betting comparison to what you have, so that you can avoid ever being completely knocked out. And I think that a plan also needs to depend on you're not trading with money that you need. I'm pretty sure I talked on that. Maybe I skipped a line. I don't remember saying that, but I'm a little nervous today, guys. This is different for me. I'm talking about one idea instead of kind of talking about Bitcoin, which I always following and always comfortable talking about. You're not trading with money that you need, which makes you much more emotionally dependent on that trade. You need to be able to accept the loss. You need to be able to accept the gain. And if you cut one of those out, you're not going to get the other side of it. If you continuously emotionally change your trade as soon as it looks not quite the way you thought it would go, you're probably going to always do that. And you're always going to take you're either going to take less of a gain than you should, or you're going to have more of a loss than you should. You made this plan, and in order to have it work, you need to stick to it. That's the only important part here. And by doing that, you've cut out pretty much all emotions. It's just numbers. You're not trading emotions, you're trading math. You're saying it's going to go here. If it goes under this, I lose a little. But if it goes here and then comes back, then I've gained this amount. So basically, everyone's going to have their own plan. Everyone's going to have their own strategy. And that's just how trading is. So my suggestion is to people who don't have a strategy, or are very new and have never thought of even having a strategy. Maybe just trade by the way it looks or something. I'm not sure. My suggestion to everyone who doesn't have one is dollar cost averaging. So depending on how much trading experience you have, doesn't mean you have to dollar cost average, but it's a great place to build a strategy from. It's simple. It's easy to understand. I think even people who have never invested can understand DCA. And historically, in almost everything, it's been pretty successful. So to successfully dollar cost average, all you need to do is look at your budget. I'm not going to give you guys a lecture on budgets today, but your money in, your money out, what you have. So how much do you want to dedicate to whatever it is you're investing, whether it's Bitcoin or gold or S&P, it doesn't matter. So it's how much do you want to, how much can you, but more importantly, how much can you do, how much can you invest with no impact to your life? And that is the most important part. You need to be able to commit whatever sum it is long term on a fixed basis and that in no way impacts your life. Like, say you want to buy a hot dog or something, every day, but you won't be able to buy a hot dog if you do this dollar cost averaging. Then don't do it. This should only be money that you're okay with losing, because there's no such thing as a guaranteed trade. There's no such thing as a guaranteed investment. And if that money impacts you in any way, you're going to see that come back so many fold in emotions. I've heard of people taking out loans to buy Bitcoin or mortgaging their house or something. There's no way any of these people ended up profiting unless they were just the luckiest people in the world. Like, they took out a loan and somehow bought at the right time and made a lot of money. For every one of those, there's 100 or 1,000 or 10,000 people who did the same, and now their life's wrecked. That is not the way to do it. People ask me all the time, like, how much do you need to invest? There's no minimum to investment. If you can only afford $1 a week, $1 a month, $5, whatever it is, whatever fits that category of not impacting you. And for some people, that's probably a lot more. There are probably people watching where it's $1,000 a week. It's all spectrums. It's not the same for anyone. It only matters what your situation is. So there's no minimum, but there definitely is a maximum. That maximum is whatever you can't afford to lose. If you need this money that you're investing in anything to pay your bills, pay your debts this month, next month, you should not invest that. None of this is financial advice, but never ever should you put a penny in any investment where you need that money by a certain date. That's just going to pile on these emotions. It's going to make you fearful when it goes against you, and it's going to make you greedy when it doesn't. It will not work out. If it does, you might as well have just played the lottery and won, because it's just not going to happen. I've never seen it happen. And I've seen, we have like 2,000 unique visitors a day in our stream, and I've seen thousands of people with this same mindset. It just doesn't work. If you need the money, you're going to make a bad decision at some point, because you have to take it out by a certain time. By DCAing, basically you're committing to making a buy, whether it's weekly or monthly or quarterly, it doesn't matter, of whatever it is you're investing in. And doing this smooths out your entry. It goes against, or it kind of defeats the, something's broke. I don't know. It defeats the all-in mentality. It's very much waiting, I like to say, slowly investing over time. It abides by the margin, or not by the margin, by the position, the trade position kind of idea of you're moving in or out slowly. And most importantly, DCA really involves no emotions. You're just making a buy on a timer, essentially, like a robot could do it. And pretty much in almost any asset, if you DCA long enough, it's done well. It's just statistically. And I think the reason for that really is just the removal of emotion. It's someone who's DCAing, it doesn't really matter to them if it's a bear or bull market, because if the price goes up, they profit. They feel great. They have some euphoria. Awesome. If the price goes down, they're buying again, and they're getting this thing at a cheaper cost. They're getting more of it. So in a way, they can really root for the price going up or down. Goes up, they profit one way. It goes down, they profit as they're gaining more of this asset. And I think that really removes a lot of bias as to where they want the market to go, as what they feel like they need. I think if you're DCAing, you're doing it because you believe in something, and it just allows you to remain emotionally neutral. You've really played the market in both directions. Let me see how much time I have. All right, we're already over 30 minutes, so I won't go into too much. But basically then once someone who is DCAing is in profit and now they find themselves buying above their cost average, they can also employ that the other way and start DCAing out. And you guys have heard me talk about that. That's pretty much what I do. I buy whenever it's under my cost, and then I sell whenever it's over. But I do it very slowly. And I do it slowly to avoid these emotional responses. So yeah, we're over the half an hour, so I'm going to just conclude this webinar. Thanks guys for joining me. Basically, main points to take away here is I feel like we're our own worst enemies in trading, and we can get an advantage on ourselves by planning ahead, because we can avoid impulsive moves, we can limit our losses, we can target our gains, and we will never invest what we can't afford to lose because we've made this plan ahead of time. So thanks for joining me, guys. This was very different. I liked it. I hope you guys enjoyed it. I'll see you guys in the stream, and happy trades.